Now, I started investing in July 2019 with 70,100 pesos as my starting capital, and I've diligently added month after month to it, except only during the peak of the pandemic wherein I had no job. My investing strategy is dividend value investing. A short explanation of it is I find great companies that pay a good amount of dividends and are trading at a fair price. It's literally value investing, so I've been doing it for more than 3 years, and so far, I'm actually doing quite well. My total return is 18.52% or 305,158 pesos. This is from my total invested money of 1,644,400. This is while the PSE index is still far away from its point when I started investing. Of the 308,000, 140,000 of it came from the dividends I got, which is almost half of it. So I can probably say that this strategy is doing okay here in the Philippine market, and it has given quite a good amount of cash flow. But this isn't a good comparison with the index, although I'm showing the value of FMETF as well, which accounts for all dividends reinvested unlike the PSEI. My comparison is assuming you only did a one-time investment in July 2019 to the FMETF fund. I was thinking, what if all my money every month I poured into this fund? So this actually lets me cost average through the ups and downs of the market. Now, before we start doing that, to familiarize yourself with FMETF, it is the only ETF in our country that tracks the PSEI, which consists of the 30 largest companies in the Philippines by capital. This consists of companies like SM, Ayala, BDO, Globe, so on and so forth. So this fund copies it because some think you can invest directly in the PSEI. No, there are some companies out there that track this index. So maybe you've heard it when getting your VUL. The only advantage of FMETF is it is available to be traded directly in your brokerage account, and so far, it has the lowest management fees, which we will discuss later on. So by investing in this fund, which mimics the PSE index, you get to own indirectly all the companies in it. You are instantly diversified. That's why a lot of great investors out there advise the vast majority of investors to just invest in an index fund, and you won't regret it. The PSE index has grown massively ever since 1987, from 500 to 6,876, and its highest peak was back in 2018 when it crossed the 9,000 mark. So just to give you a glimpse, if there was a fund like FMETF that started way back in 1987 and you invested 10,000 pesos a month in it, you would have 16 million pesos. This is from your 4.2 million accumulated invested money. You multiplied your money almost 4 times. Although there are some differences in reality, since most funds have their management fees, which I said earlier, this is by far the range you would get. Now, FMETF only started in 2013, so if there are any of you wondering why the fund hasn't moved much, well, because the PSE moved that way as well, it's just tracking it. So going back to my point, what if I just invested all my money in an index fund? Would I do better? So I track FMETF month after month. And to be completely fair, I also computed the brokerage fee. With a total invested money of 1,647,300, I've accumulated 16,052 shares of FMETF. And with the current price, I would have a total return of 3.4% or 55,241 pesos. This is not bad considering if you look at the market right now, we are still far away from recovery. This also emphasizes the importance of consistently investing every month no matter what market cycle we are in. Imagine, even though I started before the pandemic, I would still end up with a positive return. This is because during the market crash, the lowest was March 2020, I continued investing, which got me a better deal. I bought more shares. This in turn, even when the market recovered just a bit, boosted the returns. If you look at the graph, my portfolio trailed the fund by a lot during the crash. Now, during those times, most of my shares were concentrated in a few companies, which really went down hard, and this led to my portfolio dropping up to 36%, compared to FMETF that only dropped to negative 25%. Although my portfolio caught up in 2020 and passed the fund in mid-2021, I think this is because of the higher dividend yield I have compared to FMETF. Now, this is really great data, since even by investing alone in a single fund, you would still be profitable, even when the market is still far from recovery. This emphasizes why the cost averaging approach is the best way to invest in an index. Because let's face it, no one can predict the market. You would be lucky enough if you invested at the peak of the pandemic. But that doesn't happen to most investors, Like me, I invested just months before the crash, but since I looked at my investments at a longer horizon, I know market crashes are normal. The market isn't a straight uphill, it has its ups and downs. If you don't know that's going to happen, then you would have panicked when the market dropped, and instead of buying, you would have sold your shares too quickly. Just look at the history of the index alone. Although we had a lot of times when the market crashed and traded sideways for a long time, if you had a long-term approach, you would end up with huge gains. Same for my data now. The market is still trending sideways, and yet you already have positive gains. So anyways, although my portfolio of handpicked stocks beats the index, I don't know if I'll be able to continue my lead. Even expert fund managers trail the index by a landslide. Did you know that 95% of fund managers fail to beat the index? You investing in the index already beats a lot of those experts. Now, although the index has a lot of advantages, it still has its flaws, especially here in our country. Just the fact that we only have one available ETF speaks for itself. That's why they charge such a high management fee. FMETF charges 0.5% per year. Although you won't feel this because they automatically deduct this, so no matter what the market is doing, even though the fund is down, you are deducted 0.50%, which in the long run is a huge amount. Remember, you're also deducted when you buy the fund itself in your brokerage account because of the brokerage fee, which is almost closing in on 0.30%. Although the brokerage fee is only 0.25%, other fees like VAT adds up to it. And remember, you only get this minimum if you invest more than 8,000 pesos. If you invest lower than that, then you get the minimum 20 pesos fee, which is more than 0.25%. So if example you invested only 3,000 pesos, since you get the minimum of 20 pesos, your brokerage fee will shoot up to 0.66%. And if you add those other fees, more or less 0.7%. So add that to 0.5% management fee of FMETF, then you're deducted almost 1.2%, which is a lot in the long run. That's why for those saying the 8K rule isn't important, especially investing in FMETF, then I don't get it. I won't pay more than 1%. I'd rather just wait until I saved up 8,000 pesos. And there's more to it. It doesn't give you dividends. They automatically reinvest it for you into fund. It doesn't go past your brokerage account as normal individual stocks do. You have no control over it. If we compare this to indices in the USA, Vanguard, which tracks the S&P 500, has an expense ratio of only 0.03%, which is very low, and there are a lot of ETFs available that gives you a dividend income, which gives you the flexibility of where you will put the money. Now I tell you, if there's an ETF here in the Philippines that tracks the PSCI, or especially the dividend index of the PSE, and gives you dividends on a cash basis and has a low expense ratio, then I would definitely invest in it. So anyway, although it has its disadvantages, the pros still outweigh the cons. In just one fund, you're instantly diversified, and it doesn't take you a lot of capital to do. I had a well-diversified portfolio when I hit the 500k mark, and it still had a few companies compared to the index, because you need a lot of capital to spread your money in different companies. Second, you don't need to analyze one by one the companies in our market to find a good deal. Nope, you just invest consistently buying one fund. That's it. You're just clicking the buy button and spamming it every month or week if you can. Third, longevity. Since it's very easy to do, you can maintain it for a long time. Unlike for trading, or even what I do, although I'm a long-term investor, I still give a little of my time to search for companies, so you won't need other apps to help you analyze companies. And by the way, speaking of app, if you're investing in individual stocks, then Simply Wall Street can help you out. They have tons of data available for you, and it's very easy to understand. This way, you can filter out stocks with ease, and if you don't know how to compute for your intrinsic value or your buy price, then they have it for you. But of course, you shouldn't solely rely on that. And that's not all. They also have a portfolio tracker to keep you updated with the overall health of your portfolio. So if you want to sign up, you can head down to my link below. They offer a forever free usage of their basic plan, and if you do avail their paid plan using my link, you can get 30 and even up to 40% discount. So what are you waiting for? Grab this opportunity now and try Simply Wall Street. Going back, although there are disadvantages, the advantages still outweigh them. And since you're not thinking of the stocks you're invested in if it's going to go bankrupt, then again, it helps in longevity, which you will need since investing is a long-term game. If we compare to investing in individual stocks like what I do, Advantages: you have full control over where you'll put your money. Second, if the companies you're invested in pay dividends, then you have consistent cash flow. Unlike for FMETF, the only way you would get money out from it is if you sell your shares, assuming you sold it at a higher price, of course. Third, has the potential to gain higher returns. There are a lot of investors who had dominated the market with huge returns, double or even triple of the index. Investors like Warren Buffett with an annualized return of 20.1%, Peter Lynch at 29.2%, Charlie Munger at 19%, and a lot more. Disadvantages: more work because you have to research each stock you will be investing in. Second, takes more capital to be diversified. Third, for me, it has more risks, especially if we went into full speculation mode, which a lot of investors do, so it's more prone to errors and biases. So in conclusion, if you don't know anything about stocks and are willing to invest for the long run, then investing in an index fund is a better choice rather than just speculating in individual stock picking. Following what YouTubers or influencers are showing, you'd better off investing in an index. It gives you good returns and beats a lot of experts. But if you're willing and have the time to study stocks and want the thrill of choosing the companies you want to invest in, then you can go investing in individual stocks. But you have to study first and know the basics first, or you can even combine both. Own stocks and indices, which a lot of investors do. So assess yourself first. What suits you better? There's no wrong answer. It all depends on you. Both, if done correctly, has the potential to grow your money a lot. So thank you for watching, and if you learned something from this video, then I would appreciate it if you click the like button before you leave. See you in the next video.